Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, June 21st, 2024. For the past month, I have noted the disparity in performance between the cap-weighted SPDR S&P 500 ETF Trust and the Invesco S&P 500 Equal Weight ETF as evidence that Wall Street is in a risk-off mode. Last week, I included a chart to illustrate that point. Now, here is the SPY over the year to date, and you see way over here on the right, it did dip down a little over the last couple of days, but it's still, if we look at say, let's go back to the past month, it's definitely hit a new high actually just a few days ago. But the problem up until now has been that smaller stocks were not participating. However, that trend may be reversing. During the past week, both the RSP and the SPY gained ground at the same time. So here's now the equal weight S&P 500, and you can see over here on the right that for the past month or so it's fairly flat. But again, and it's not a big trend, but if you look over here, it bottomed out a week ago on Friday, and now it's also ticking up. Perhaps more tellingly, the iShares Core S&P Midcap ETF, IJH, and I'm going to show you that chart here, and the iShares Core S&P Small Cap ETF, or IJR, are also up this week. So here are mid-cap stocks, and again, if we go out, year to date, you can see there's kind of this downward trend over the past 2 months or so. But again, if we just look at the past month and then especially the past week, you can see here a pronounced upward shift. Same with the small cap. Year to date, this is a downward trend. During the past month, also downward, but then look at the last 5 days, you see this little spike. In other words, Wall Street is buying stocks of all sizes instead of selling smaller stocks to buy bigger ones. That is primarily due to recent economic data that suggests inflationary pressures are once again abating, increasing the chances of a Fed rate cut during the third quarter. And that's what the bond market seems to think. Since cresting above 4.6% 4 weeks ago, the yield on the 10-year Treasury note fell below 4.3% this week. So here is the 10-year Treasury note yield year to date, and you can see it's been in a downward trend over the past year, so far over the past, let's call it 2 months. But again, look here, and it's also clearly now continuing that downward trend. Now, the same is also true for the 5-year Treasury note, which is more sensitive to short-term changes in interest rates. And you can see it's also downward trend, and especially during the past month. So I closed last week's update by stating, the good news is that Wall Street is not abandoning the stock market altogether. If it were, then both the RSP and SPY would be falling. The bad news is that this trend will most likely remain in place until a rate cut appears imminent. Until then, it will be difficult for all but the largest companies to make much headway in the stock market. But now that a rate cut is starting to appear likely, if not imminent, stocks of all sizes can make headway, as they have this week. If that trend continues, then the second half of this year could witness a rotation out of mega-cap stocks into smaller companies trading at much lower multiples to sales and earnings. Now, that's why my portfolio updates this month have focused on mid-cap companies trading at relatively low valuations. So I'm going to show you a chart here for Altria, a cigarette manufacturer. So not only is Altria's forward price-to-earnings ratio of 9 less than half the same multiple of the S&P 500 index, but its forward annual dividend yield of 8.6% will look increasingly attractive to income investors as bond yields fall. Also, semiconductor manufacturer Western Digital is valued at only 12 times forward earnings despite rapidly improving fundamentals for its sector. As I opined in my recent update on the company, Western Digital may finally be in a position to expand its profit margin. That is true for many of our portfolio holdings that have not fully participated in the stock market rally this year that favored the biggest companies. For that reason, I believe that now is a good time to build positions in mid-cap and small-cap stocks trading at low multiples. That's this week's update, and I look forward to talking to you in another week. Thank you.